This is Trepp Wire with this special guest podcast, REIT Performance. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS commercial real estate and CLO markets. I'm with Joe McBride, head of CRE Finance, and joining us today is John Worth, Executive Vice President, Research and Investor Outreach with Nareit, the voice for REITs and publicly traded real estate companies. John, welcome.
Thanks for having me. I'm a long-time listener, first-time caller, as they say. So I'm very excited to be on.
Well, welcome. So you know the drill. Give us a little background about yourself and Nareit. If folks don't know about your organization, you give them a background on that.
Sure. I'm the head of research and investor outreach at Nareit. And as you said, Nareit is really the voice for real estate investment trusts, REITs, both in the U.S. and globally. And REITs are a really important piece of the commercial real estate infrastructure, especially in the United States. So there's 145 million Americans, we estimate, in the US who own REITs, primarily through their 401ks, pension plans. And REITs own and operate between 10 and 20% of commercial real estate in the US. So they're the way the vast majority of people are getting their real estate exposure in their personal portfolios, and they comprise a large and growing share of commercial real estate in the U.S. So put together, public and private REITs own about 3.5 trillion in real estate. Public listed REITs is between 2 and 2.5 trillion, and currently have a market capitalization of about 1.2 trillion, including obviously some of the largest real estate companies in the world.
And John, I mean, we're very commercial real estate centric, but are there kind of residential REITs included in those numbers?
So you've got really two types of REITs that I think are important to distinguish between equity REITs, which own and operate properties. That's about 95% of the market capitalization. And then mortgage REITs, who own mostly mortgage-backed securities, but also some whole commercial loans, represent about 5% of that pool. And really the distinction between the two is that equity REITs are owned primarily in both individual and institutional portfolios, where mortgage REITs are more of an individual portfolio. People use them to get their fixed income mortgage-backed allocation within their portfolio, and they provide a very strong income component. REITs are known as income generators. They have a yield that's generally about twice the broader stock market, and that's been true for many years. Mortgage REITs have an even larger income component and really are often used as part of an income portfolio.
It's been about a year since many of us were ushered home to work, and we're coming up on a year, I think, in about a week or so that happened. Walk us through the past year in terms of performance.
Yeah, happy to do it. And as you say, it's been about a year since we saw the market start to react in late February, and we're coming up on about a year since most of us were ushered out of our offices. For us, that anniversary will be, I think, on March 12th. We're coming up on it. A couple of things I'll note about the year that I think are worthwhile. The first is to just draw a comparison between this crisis and the financial crisis, which was two really important periods for REITs. And I think one thing that has really marked REIT performance this year has been resiliency. So REITs really came into this crisis in a very different place than they came into the financial crisis. They came in with very strong operating performance. They came in with historically low leverage, and the leverage that they were using was termed out quite well. So even today, the average term to maturity is over 80 months for REITs. So they've really structured out their debt quite well. And they also came in with substantial amounts of cash, and most importantly, lines of credit ready on their balance sheet. So during those critical early months, the REITs who were in some of the more distressed sectors, retail, hotels, as the most distressed sectors, particularly in those early periods where they were receiving, no rent, 50% of rents, they weren't running into cash flow problems. They had access to cash on their balance sheet and the security of lines of credit. But as we break up the year, I think we're looking at it really in three segments. You had this first period from about February 21st till near the end of March, which was really kind of the plummet as both broader stock market and REITs and commercial real estate people were trying to get their head around what was going on, trying to do some valuation in a world where it just seemed like every day you had new bad news in the paper, and so over that period the total index fell almost 41%. So we had a period in late in March where REITs on a year-to-date basis were down about 24%, but had dropped very precipitously over that month, and that was really the sectors. All the sectors fell during that period. The drop was most precipitous for hotels and retail, which are the most connected to in-person experience. We also saw a lot of difficulty in the healthcare sector, as again investors were trying to wrap their head around what the implications were going to be in that sector. We then moved into this period from March really through November, early November, where we saw a lot of recovery. The market was up dramatically, and that was led by the digital sectors. So data centers, cell towers, and our industrial and logistics sectors were really leading the way, as those were the sectors that not only had their secular tailwinds, but of course were supporting work from home, e-commerce, and sort of the new way that we're living during this pandemic. And then the third period really started with November 8th, and that's an important day because we got some very good vaccine news on that day, and that really kicked off this vaccine rally that we've seen over the past couple months, where REITs as a whole are up about 12%, but we've really seen a flip where the previously distressed sectors of retail and hotels have really been leading the way, as investors are increasingly optimistic about the prospects for returning to life as normal or approaching normal in the coming year. So it's really sort of a tale of three segments of the year that I think gives some good insight into where investors are with respect to what the future holds.
So John, did you buy the dip?
I did actually. We're not allowed to own individual names, but we can buy mutual funds and ETFs, and I'm always bullish on REITs. So.
Good job, very well done. Although you could have bought almost anything at that point and done well, but yeah, that's awesome. That's great to hear. So two things. First was, and kind of going back a little bit, you mentioned how the REITs came into this kind of well capitalized, right? And we hear similar, there's a similar theme in the banking world and the finance world where, the banks were overcapitalized and their underwriting was strong and all that coming into this. And it's good to hear the same thing from the REIT side. Can you give us a sense, just kind of like a quick educational portion here about what types of debt that REITs use? We're very used to, in the Trepp side, looking at the CMBS debt, the non-recourse loans on the properties or the mortgages on the properties. But I know that, I see record REIT bond issuance last year or the last few years. And I know that there's lines of credit and other. Give us kind of a sense of how REITs normally capitalize themselves.
Yeah, and this has changed over time as REITs have become larger, as a broader swath of REITs have gotten investment grade credit ratings, and so today, about 70 to 80% of the debt REITs issue is going to be unsecured debt, sort of at the entity level, with the balance being mortgages on specific properties that might end up in a CMBS, and that differs a bit by sector. So one of the sectors that has traditionally been mortgage heavy has been in the mall sector, just because of some of the way those deals get structured at origination. But over time, we have seen this move, particularly among the investment grade REITs, to move towards unsecured debt, and that's a very large, several $100 billion market now in terms of REIT financing is really critical. And then the innovation that we really saw used in this crisis, and not that much of it has been drawn down, but REITs came into the crisis with over $100 billion in lines of credit available, and only a small percentage of that has actually been tapped. But that really gave a lot of confidence to the market that they weren't going to have to issue equity at dilutive prices and hurt their existing shareholders, which was one of the sort of follow-on lessons from the financial crisis, to be able to come in with lower leverage, more access to on-balance sheet financing. I think really helped the REITs. And I would say, in terms of their credit condition, we saw a lot of REITs, like all other sectors, I should say, put on watch list in terms of their credit ratings, but we've seen very few downgrades in REITs. In fact, when we look across the sectors of the stock market, REITs are actually the third best performing in terms of the share of market capitalization that's been downgraded. And I think that goes back to the stability of the balance sheet and some of the work they did coming into the crisis.
Got it. So another one there, you mentioned, you kind of bait and switched us a little bit when you mentioned November 8th. The other thing that happened in November was the election. What are you hearing, or what's kind of the feeling among REITs in terms of potential new regulations or, higher taxes? I mean, this is a big question, higher property taxes in states that have had drops in revenue, or, even maybe we'll get into it later, but we can talk about stimulus as well. But is there any sort of overall feeling in the sector on potential new regulation or taxes?
Yeah, I'm not sure there's an overall feeling. There's an enthusiasm to get more stimulus into the economy. One of the lessons, I mean, we know it in your bones, but you really felt it back in March and April of a crisis like this, is how the financial health of landlords is intrinsically linked to the financial health of the tenants. So, one of our big points of emphasis in terms of talking to lawmakers and the administration has been, we got to support tenants. And in fact, some of our legislative initiatives have been about how REITs can do more to help their tenants within the REIT rules. As we look forward, obviously, I think we're going to see both risks and opportunities, not for REITs, but for real estate broadly. I think there's real opportunities in terms of infrastructure and infrastructure expansion, and creating ways to do infrastructure in the future that help broad swaths of Americans invest in it, like they do through REITs. And obviously, the tax situation is going to be a question mark. We could see corporate rates go up. We could see individual rates go up. But all of that is, to be determined, and is going to play out in the political arena. But I think those are I think a bit of a sideshow relative to getting the economy growing, making sure that the tenants their businesses are growing, and that's going to be the core of what drives REIT earnings.
Amen.
Speaking of earnings, we're still in the middle of the reporting cycle, but what are some of the takeaways? And if we can gather what the future holds based on the reporting of earnings, what does it tell us?
I think that what we're seeing, and I'm going to talk a little bit about a product that Nareit puts together called T-Tracker. And what we do in T-Tracker is we pull together not the earnings reports, but the actual earnings results of all the REITs, and put them out at an aggregated basis that we can divide by sector. And it creates a very nice sort of guidepost for where the industry, and I think all commercial real estate tends to track with REITs. It provides a nice guidepost for where it's going. And what we're seeing is I think positives and negatives in the earnings we've seen so far. FFO, which is the REIT measure of earnings, sort of kind of adjusted for depreciation, so you can get a better look at what's actually going on. FFO is going to be down from a year ago. Right now, we're thinking that's going to be in the mid-teens versus the fourth quarter of 2019. So obviously, that there's been some tough sledding. When you disaggregate that by sector, you get a different story. You see that the vast majority of the declines are going to be in your retail and hotel sectors. Outside of those sectors, you've seen growth in some of the digital economy sectors, in industrial and logistics, data centers, cell phone towers, and the balance we've seen performance which is not great, but not terrible. And when we look over the last couple of quarters, what we see is that we're seeing quarterly growth. So it looks like outside of retail and hotels, we're basically about halfway back from where we were a year ago in terms of FFO. The other glimmers of good news, and I think they're maybe more than glimmers. One is that rents are getting paid. We were doing a rent survey this year. Back in April, we were seeing in some sectors 50-75% of rents being paid. Listening to earnings calls, what we're hearing is across the board, 90+% of rents being paid, even in the hard hit retail sectors. So that's exceptionally good news. We're seeing REITs getting back into acquisition mode. We're seeing that they're reporting having acquired properties. That's a signal that they're optimistic about the future. And what we're hearing on the earnings calls is generally a sense of optimism for late 2021. And that varies by sector, but that gets into a topic I know you've discussed on the podcast, which is what is the post-COVID world going to look like, and how close are we going to get back to normal? And so we're getting in questions there about, well, how will people go back and experience retail? Are people going to want to go on vacations and stay in hotels? Is business travel going to come back? Work from home? All those issues, I think, are getting built into current REIT valuations, and we're going to learn a lot over the next year and a half about what was permanent and what was transitory from this crisis.
Well, I personally think at some point in late 2021, it's going to look a lot like that Super Bowl parade on the water with Tom Brady throwing the Lombardi Trophy. I think people are going to be dancing in the streets. At some point, we're going to reach that tipping point where enough people have gotten vaccinated and the people who haven't are not too worried, and they actually reopen some things in the cities, God willing, and we're going to have some serious fun, I hope. But I guess that's kind of an aside. John, in terms of the longer term prospects, the one that we've been talking about a lot lately is office, of course, right? So here we are on a Zoom, right, doing our podcast, and this is our life now, is on Zoom. No signs, at least in the New York, Chicago, San Francisco type, lockdown cities, of returning to the office anytime soon. Like, what's kind of what are your feelings on that? And am I overblowing this potential risk because I'm narrowly focused in my little space in New York, or is this really something that people are thinking about?
It is absolutely clear it's something people are thinking about. That is for sure. I personally am bullish on offices, by which I don't mean that work from home is not going to become part of our norm in some degree. But I've worked in organizations that had large swaths of the employees working remotely, and I really came away with the lesson that that's no way to run an organization. It's very hard to build culture. It's very hard to get the message from management out to the troops. And I think what you find, and there's plenty of research that indicates this, that you really end up with this bifurcated population of employees, those who come to the office who are in the know, who get the promotions, who move up the ranks, and those who don't. And I think it really can hurt an organization over time. And I know, there was just a piece from Goldman today saying their goal is to get back to having a norm of being in the office over time. There's a lot of opinions out there, and obviously, the market for office space right now is is quite diminished, right? We're not seeing a lot of demand for new leases. We're seeing subleases growing. So it's a tough, conditions are tough in the office market. My own sense is when we get back to a sense of normalcy, when people start coming back to the office, even if we're coming back 4 days a week, I don't know that diminishes square footage all that much. But and my sense is organizations are going to find over time they need to get people in person. You were talking about we're on Zooms all day. I'm on Zooms all day. I can tell you for sure, my effectiveness at 5 o'clock after being on 6 hours of Zooms is nowhere near the same as it is being in the office, even if I have 6 hours of meetings, because you're invigorated by being with people physically, and traveling to do in-person meetings. We know that we get more out of those meetings. We think the investors we meet with get more out of those meetings when we're in person. We build those relationships, and I think all of that has to happen in offices. So that said, it may be some time before people come to that realization. So I think it's one of the things we look at and that we see is when you look at the 1 year from February 21st to this Monday, the sector that actually has performed the worst is not retail. It's actually office, because office was dragged down during the early days of the crisis and hasn't had the vaccine-driven recovery that retail has had. So there's definitely, I think, work from home is the single biggest question mark in real estate. I think you're absolutely right about that. My personal position is I think we're going to see a lot more people in the office for a lot more time than they're thinking right now in the bubble of working from home and COVID.
Like I've said a few times to some of our guests, from your lips to God's ears, I'm ready. I'm not looking forward to the commute. And I know that a lot of people, especially in the New York area, have very long, arduous commutes. So I'm not looking forward to that. But I agree with you. I remember the article that came out early in the pandemic about how our brains are not wired to communicate in this way. And that's why at 5 o'clock, you feel like you're going to pass out, right? Because your brain takes so much more energy to pay attention to a screen and these disembodied voices than it does, sitting around the campfire or sitting around the conference table.
Yeah, that's absolutely right. And commuting's no fun, but people need to get back in their cars, put on your podcast, get on the train, put on your podcast, and make the most of the time, right?
That's right. That is true. They do say podcast listening is way down during the pandemic. Yeah. So ours is way up during the pandemic because that's when we started.
It's a lot of dog walking.
Okay.
A lot of dog walking.
That's right.
Swim lessons.
Exactly.
Golf, driving range stuff.
So, John, when do you start having conferences in person as an organization? When does Nareit go back in the flesh?
Our goal right now is to have an in-person conference in September, I'm there. And we're very committed to having. We have a big conference in September. We have one in November. We're hoping we'll be in person in September, and for November, I feel quite confident we'll be there. So it's going to be interesting when, and I think people are going to have a comfort level for doing things personally and a comfort level for doing things professionally, and the professional may lag the personal, frankly. Sort of when I look around my neighborhood, I can see it out my window here, right? Lots of people have gone on vacations. They've traveled for personal business, or traveled for leisure. But I don't think they would be as comfortable traveling to a conference hotel and sitting with 400 or 500 other people. In our case, a couple thousand people. I think by later this year, we'll hopefully get over that hurdle and have that comfort level back. And that's part of what we're seeing in the optimism around hotel stocks.
So we'll let you give some predictions and forward-looking comments. We won't hold you to them, but our listeners might. So what's in store for REITs? You've talked a little bit about which sectors are performing better than others. What do you think for this year? Any predictions, anything that might be a surprise?
Well, I'm not sure if there's surprises. I mean, I kind of see three key themes for the year. The first is return to normal. So that is this sort of getting back to retail, getting back to hotels, seeing people increasingly getting back into the offices. The second is, this digital economy. We have sectors of the REIT market today. It's nearly 40% of REIT market cap is linked to the digital economy. That's up from just 10% 10 years ago. And those tailwinds are going to continue unabated. That's a long-term trend. Yeah,
those are
absolutely.
Industrial, data center. Do you include cell tower in that?
I do. Yes, very much.
Okay.
Yeah. So those are really the three pieces. And
Right.
and industrial, we have non-e-commerce linked industrial. We've got cold storage and
Right.
and other innovative pieces of industrial, but by and large, the bulk of that is really we call it industrial. It's truly logistics.
Right.
It's part of that e-commerce fulfillment chain. The third piece that I think is just continuing unabated, and we're hearing it more and more from investors. It's something that our member REITs are spending more and more time on. Is just the continued interest in ESG, and and the growth of interest in both documenting and starting to hit targets on what you're doing, in terms of environment, your social obligations, and your corporate governance. So those are kind of the three themes that I think are going to sort of dominate 2021. Probably 2 and 3 are probably going to go well beyond 2021, but they're certainly part of the conversation this year.
So kind of a nitty gritty question, but maybe not. So there's a lot of conversation these days about inflation, right? And trillions of dollars being printed and stimulated into the economy, which classic economics people think there has to be inflation. And I'm less thinking about inflation, but if the Fed and the markets in general have to bid interest rates higher, that's generally a concern for yield-based stocks. But I guess give me your sense of inflation expectations and any worries about rising rates.
It's a topic that is obviously increasingly on people's minds, and it's something we're always happy to talk about. As we look at inflation, I personally don't see a lot of risk of inflation anytime in the near-term horizon. We have seen some price increases. Obviously, we could talk about rates. We've seen the 30-year and the 10-year treasuries get bid up by about 30 basis points over the last month or so. They're still 70 basis points below where they were a year ago. But to get inflation, we're going to need to see wage pressures. And here we're sitting with unemployment over 6%. If you include people who are marginally attached to the labor force, that's about over 11%. Both of those are up 3% from pre-crisis. Labor force participation rate in the low 60s. We've got a long way to go before we're going to see the kind of wage pressures that are going to lead to broad-based inflation. When it comes to treasuries getting bid up, what we see with REITs in particular and interest rates is actually quite interesting. We see the short-term correlations actually flip back and forth over time. When I'm talking about daily moves between REITs and 10-year treasuries, really we see that go back and forth, and a lot of what it seems to really drive whether it's a positive or negative correlation is actually where we are in the short-term monetary policy making cycle. And so more importantly is, I think, what happens over a year. And what we see consistently is that when treasuries are rising, if you look at one-year intervals, a one-year interval where treasuries are rising, REITs are going to go up about 80% of the time, and they're actually going to beat the broader stock market about 50% of the time. And the reason for that is it matters why the 10-year rates are rising. If 10-year rates are rising because of optimism about the economy, REITs provide income, but they're not fixed income. As a REIT investor, as those rents go up, as FFO goes up, that flows through to you both in terms of higher dividends, but also in terms of price returns. So what we've seen is that for long-term investors, REITs are actually quite durable with respect to rising rates. REITs, like all real estate, have typically done well during inflationary periods, beating the broader stock market. So I don't see it on the horizon, but it's not something that I think it is particularly troubling for REITs, actually.
That makes a lot of sense. So in general, if I'm explaining this to my sophomore in college students someday when I go back to teaching in real life, someday return to normal, hopefully, that's the spiel, right? When interest rates are higher, it means that there's higher expectations of economic growth in the future. Inflation,
yeah,
it's good to own assets when, like real estate, when there is inflation, right?
It's good to own assets that reprice, right? And REITs and all real estate have typically built escalators into leases, have structured leases so they've got substantial proportions of their portfolio turning over every year. So they've been able to inflation protect. And yeah, on the monetary policy, it really matters why rates are rising. If they're rising because we've got the central bank shocking rates to stop runaway inflation, that's unambiguously bad for real assets. Obviously, if your only exposure to the real assets is through fixed income, obviously higher rates are not going to be good for you. But when you're owning equities, it's a different story.
Well, with that, we'll close this special podcast. Thank you to John Worth from Nareit, and thanks to our producer, Haley Keene. Join us later this week as we look at what's happened during the week and how it may be impacting you. If you have a question, send us an email at podcast@trepp.com. Please visit trepp.com for more info and subscribe to the podcast with your favorite provider. Thank you for listening and stay well.
All right.